All right, today we're pulling apart a fascinating financial news report all about the investment firm Schroders. We're going to break down the forecast, crunch the numbers, and get to a pretty surprising conclusion. So let's get right into it. So I want to start with just one number, 14.94%. This is the figure that really caught our eye, and it's pretty much the whole reason we're talking about this today. So what on earth does it mean? Well, that's the potential upside, the growth that one major bank thinks Schroders stock could have. An upside of nearly 15%? Yeah, that is definitely something worth taking a closer look at. And this all comes from a brand new forecast. So where is this optimistic number actually coming from? Well, it's from a new report put out by the Royal Bank of Canada, or RBC. Let's dig in and see exactly what they're saying. Okay, here's the breakdown. RBC has slapped a buy rating on the stock, and they've just nudged their price target up a little bit, from 4.35 to 4.40 pence. Now, based on where the stock was trading when they wrote this, that new target is what gives us that nearly 15% potential upside we keep talking about. It's a pretty clear signal of confidence from their team. But, as any seasoned investor knows, one bank's opinion is just that, one opinion. It's never the whole story. To really get what's going on, we've got to zoom out and see what everyone else is thinking. And this is where the picture gets a whole lot more complicated. Turns out, when you actually average out all the analyst ratings, the consensus is not buy at all. It's hold. And what that basically means is most analysts are saying, it'll probably do okay, move with the market. But it's definitely not a screaming buy right this second. And this chart really shows you that split perfectly. You've got 4 analysts saying hold, and that just barely outnumbers the 3 who are saying buy. So yeah, there is a very clear division of opinion here when it comes to Schroders' future. Okay, now let's look at the actual price targets. And I really want you to see the range here. I mean, look at this. On the high end, you've got UBS Group, who are even more bullish than RBC, saying 455 pence. But then all the way on the other side, you've got Jefferies with a hold and a target of just 390. That is a huge spread. The takeaway here is pretty simple. Nobody seems to agree on what this stock is actually worth.
All right, so the analysts are all over the place. It's a total mixed bag. So you know what? Let's turn away from all the forecasts and opinions and just look at the hard data, the company's actual financial snapshot. First up, let's talk size. Schroders has a market cap of 5.94 billion pounds. So right away, you know we're not talking about some small-time firm. This is a very significant player in the financial services world. Next, let's look at a key valuation metric, the price-to-earnings ratio, or PE. It's sitting at 17.17. And for anyone who's new to this, it's just a quick way investors try to figure out if a stock is cheap or expensive compared to how much money it's making. Okay, now let's talk risk. We're talking about beta. Basically, beta measures how volatile a stock is compared to the overall market. So a beta of exactly 1 means it just moves along with the market. Schroders' beta is 1.17. That means it's a little bit more volatile, a little more jumpy than your average stock. Definitely something to keep in mind. And here's just a quick rundown of some other key numbers from their latest report. We've got earnings per share at 9.10 pence, a pretty solid net margin over 12%, and a return on equity of 8.65%. And you can see how the stock's been bouncing around over the last year, from a low of about 283 all the way up to a high near 429. Okay, so we've looked at what the analysts are saying, we've looked at the company's books. Now let's investigate another really intriguing piece of this whole puzzle, insider activity. In other words, are the people inside the company buying or selling their own stock? The article we're breaking down mentions a recent transaction. An insider, a guy named Richard Oldfield, bought 68 shares of Schroders stock. Now, on the surface, you hear insider buying, and you think, hey, that's a great sign. But let's just dig into the details here. The total value of that purchase? Just over 250 pounds. Wait, what? Yeah, that is an incredibly small transaction. Honestly, this is what you'd call a red herring. It's a little bit of news that catches your attention, but it's really just a distraction from the real story. Because that tiny little purchase is just one tiny piece of a much, much larger picture. The real headline here isn't about one guy buying a few shares. It's about the entire ownership structure of the company. Get this, a whopping 86.23% of the stock is owned by corporate insiders. Let me say that again, over 86%. That is an unbelievably high level of insider ownership. What it means is the people running the show have a huge amount of their own skin in the game. Their success is directly tied to the success of every other shareholder. Okay, so we've seen a positive forecast from one bank, a pretty mixed consensus from everyone else, some solid-looking financials, and just massive insider ownership. So where does that leave us? Let's finally get to the verdict from the article we've been pulling apart this whole time, and I promise you, it's probably not what you're expecting. So here's the dilemma in a nutshell. You've got that really bullish call from RBC, but everyone else is kind of saying, meh, it's a hold. The numbers look decent, and insider ownership is through the roof. So what's the call here? Is Schroders a stock you should actually be considering? And the answer, from the very publication that reported on all this data, is a surprising and very clear no. Yep. After starting this whole thing off with that eye-catching 15% upside, the article itself does not end up recommending you buy Schroders stock. It turns out the entire analysis of Schroders was basically a big setup. The article uses all these mixed signals we've been talking about to pivot, and instead it highlights 5 other stocks that it says analysts think are better buys. It's a really fascinating look at how financial news sometimes works. Just because you see one positive forecast, it doesn't mean it's a universal recommendation. And all of this leaves us with a final, more provocative question. Why would a publication spend all this time featuring a stock with a positive forecast only to turn around and say, actually, go look somewhere else? It's a really great reminder to always, always look past the headline. And it really makes you think, what does this tell us about the business of financial news itself? Welcome to The Explainer. We're all about breaking down the stories that are hidden right there in the data. So, here's a question for you. A stock price target moves by just 5 pence. Why on earth is that news? Today, we're going to dig into a tiny change in a stock forecast that actually tells a surprisingly big story about market confidence. I know, it sounds insignificant, but in finance, even the smallest signals can create some pretty major waves. All right, so let's get into it. First things first, we need to decode what a price target even is. Think of it like a weather forecast for a stock. So what is it really, and why should you care? You can really think of a price target just like an expert's weather forecast. It's an informed prediction, right? It's not a guarantee you're going to get sunshine. At its core, it's an analyst's best guess about a stock's future price. And its value? Well, that comes from the expertise of who's making the call. You trust a meteorologist for the weather. Investors do the same with financial analysts to figure out where a stock might be heading. So yeah, the key takeaway here is that it's a professional opinion on where a stock's value is going. Is it undervalued, overvalued? This is the tool investors use to figure out if a stock is a potential bargain, if it's priced just right, or, maybe a little too expensive right now. Okay, let's get to the main event, the Schroders update. We're going to look at the specific numbers from RBC. This is the news that got us started, and it involves 2 really big players in the world of finance. This is where our 5 pence story really kicks off. So, on one side, you've got the analyst, RBC, the Royal Bank of Canada, a huge global financial institution. And on the other side, you've got the company they're analyzing, Schroders. They're a major British blue-chip asset management firm. These guys are a really big deal. All right, so before this update, RBC's analysts had their price target for Schroders set right at 435 pence. That was their prediction for the stock's value. Then they issued a new revision. They bumped that target up just a little bit to 440 pence per share. And there you have it. That's our 5 pence change. And hey, just a quick side note in case you're wondering about GBX, it's simple. It just stands for Great British Pence. So 440 GBX is £4.40. It's just the way they do it on the London Stock Exchange. Now, this new target of 440 pence isn't just some random number they pulled out of a hat. It actually suggests a potential upside of almost 15%. So what does that mean? It means RBC thinks the stock could grow by that much from where it's trading today. That's a pretty strong signal. Okay, so is RBC out on an island with this optimistic view? Or is everyone feeling this good about Schroders? To really get why this update matters, we've got to zoom out and see how their opinion compares to the rest of the market. When you look at the consensus from other analysts, the feeling is, well, cautiously optimistic. It's a mixed bag, really. You've got 3 analysts saying buy, but 4 are saying hold. A hold rating basically means they think it's stable, but maybe not poised for huge growth. So it's not exactly a roaring endorsement from everyone. Okay, this is where it gets really interesting. Look at how RBC's view stacks up. Their target is 440 pence. The
The average target from all the other analysts? It's down around 410. That's a pretty big gap. This tells us that RBC is way more bullish, or optimistic, about Schroders' future than most of the other experts out there. So where is this confidence coming from? Well, it's not just a gut feeling. It's backed by some solid signs of financial health. Their earnings per share, or EPS, is looking good. You've also got insiders, people high up in the company, buying shares, which is almost always a sign of confidence from within. And let's not forget, Schroders is a stable, blue-chip company. That kind of stability is a big plus, especially when the market feels a little shaky. And all of this brings us right back to where we started. Why does a tiny 5 pence increase actually matter? It's not a huge jump, so what's the big deal? Here's the deal. There are 3 key takeaways. First, this little nudge is a huge symbol of confidence. You've got a major bank like RBC saying, we still believe in this company's strategy. Second, you can see it as a kind of barometer for the whole financial services sector. It hints at a more optimistic outlook as markets recover. And third, these little signals have a ripple effect. They can guide what other investors do and help build positive momentum for the stock. So at the end of the day, it's a clear positive signal to the market. It says that Schroders is financially solid and has room to grow. Honestly, it's less about the 5 pence itself and way more about the direction of the change. And of course, the powerhouse institution that's making the call. So if a tiny 5 pence change can tell a big story about confidence, just imagine what else the markets are telling us. The next time you see what looks like a minor headline, maybe you'll see it differently. You'll know there's probably a much deeper story there, just waiting to be unpacked.